How much you need invested to earn $1,000 per month in dividends. What if $1,000 in passive income paid you every single month without you having to clock into a job? Not by day trading, not by flipping houses, but simply by owning the right dividend-paying stocks or ETFs. In this video, we'll break down exactly how much capital you need, which stocks and funds pay the biggest yields today, and realistic ways to build a portfolio that could deliver that passive income goal. Let's dive in. To earn $1,000 per month, you need $12,000 per year in dividend cash flow. The math is simple. Required investment equals annual income divided by dividend yield. So if your portfolio pays a 4% average dividend yield, you need $12,000 divided by 0.04 equals $300,000 invested. At 6% yield, you'd need $12,000 divided by 0.06 equals $200,000. That's the range income-focused investors often talk about. Roughly $200,000 to $300,000 depending on yield. But real yields vary greatly based on what you hold, and risk matters. Let's look at actual dividend yields from popular stocks. Data as of early 2026. Higher yield dividend stocks. These are names many income investors consider. Altria Group MO, 6.96% yield, a tobacco company with decades of increases. Pfizer, PFE, 6.89% yield, a large pharmaceutical company with consistent dividends. UPS, 6.9% yield, a major global logistics company that has recently seen its yield rise due to stock price movements. Verizon, VZ, 6.84% yield, a strong telecom with long history of payouts. If you built your portfolio entirely with 7% yielding stocks, the math flips. $12,000 divided by 0.07 equals roughly $161,000 invested. That's notably less than the $300K estimate, but these companies can be riskier and less predictable in dividends. Not all dividend stocks pay huge yields, and that's okay. Here are established, more stable dividend payers. Coca-Cola, KO, 2.78% yield, legendary reliability. Johnson & Johnson, dubbed, 2.26% yield, healthcare giant with decades of increases. Procter & Gamble, PG, 2.79% yield and consumer goods staple. If your portfolio averaged just 3% in yields, you'd need $12,000 divided by 0.03 equals $400,000 plus invested. So the more conservative and stable the stocks, the more upfront capital you'll need. You don't have to pick individual stocks. Dividend ETFs offer income with instant diversification. Some high-income ETFs yield in the 8 to 10% range, e.g. covered call or income-focused ETFs. Others, like Dividend Growth or Aristocrat ETFs, yield 2 to 4%, but with more stability. An example from data, a high-yield ETF with a 10.5% dividend might only need about $115,000 to $308,000 to reach that $1,000 per month mark depending on share price. Some ETFs even pay dividends monthly, which makes tracking your income easier. So what's realistic? Here are 3 common approaches. Approach number 1. High yield first strategy. You aim for stocks or ETFs with higher yields to reduce the capital needed sooner. Lower barrier, higher risk. Approach number 2. Balanced dividend portfolio. Mix stable dividend growers like KO, J&J, PG with high yield names like VZ, MO. Balance income with sustainability. Approach number 3. Dividend growth strategy. Focus on companies that increase dividends over time. Slower start. Powerful long-term compounding. One investor community shared that portfolios around 300K to 365 diversified across ETFs and stocks can realistically hit or surpass $1,000 monthly. There's no one single answer, but the math doesn't lie. $200,000 is possible with higher risk yields. 300,000 to 400,000 is more typical for diversified dividends. Your strategy, risk tolerance, and consistency matter most. In the next video, we'll break down how to choose the best dividend stocks and ETFs for your portfolio, including what financial metrics truly matter. Thanks for watching, and I'll see you in the next one.